Welcome to Simple Investing Secrets. In this video, we'll review 15 of the best stocks to own in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Stocks and investors have had a difficult year this past year. 3 of the major indices entered bearish territory. Additionally, the Nasdaq has fallen by about 27% since the beginning of January. However, this period won't last forever. Eventually, bear markets are followed by bull markets. We don't know when this transition will happen. But it's still a great idea to plan for it. Especially since so many companies with solid long-term stories have seen their valuations plummet. And some players have exciting catalysts ahead. Now is the perfect time to buy companies that can grow revenue and thrive when things improve. Earnings performance should lead to stock market gains over time. Let's go over our top 15 stocks to buy in 2023. Number 15. Meta Platforms, ticker, META. Meta Platforms continues to attract a lot of negative media attention, most recently for its plans to lay off 13% of its staff or more than 11,000 employees. That came after the company run by Mark Zuckerberg issued third quarter earnings per share of $1.64 versus the $1.89 that was expected on average by analysts. Meta's Reality Labs unit, which is responsible for developing the company's virtual reality headsets, has lost more than $9 billion this year. Yet despite the hiccups, there are still reasons to like Meta stock. Currently trading at $114 per share and down 64% in the last 12 months, Meta Platform stock looks like a bargain now with a price-earnings ratio of only 10. In fact, Meta shares are so cheap that some on Wall Street have taken to calling it a value stock. Professional and institutional investors who are on the hunt for undervalued growth stocks are buying Meta Platform shares hand over fist. Although the company continues to struggle with some external challenges that include a strengthening US dollar, a slump of ad revenue, the rise of Chinese social media rival TikTok, and changes to Apple's privacy measures, most of these problems are expected to resolve themselves. Meta reported a 20% operating margin and $4.4 billion of net income last quarter, showing it remains relatively healthy. Number 14. Alphabet, ticker, GOOG and GOOGL. It's hard to ignore the shares of Google parent company Alphabet when they're trading at less than $100. Currently changing hands at $96 and down 34% over the past 12 months, Google stock has a price-earnings ratio of just 19, which is extremely cheap for a company of Alphabet's size. A casualty of market and economic forces, Alphabet needs online advertising revenue to rebound in order for its stock to meaningfully recover. The dearth of ad spending, particularly on YouTube, has led to several disappointing quarterly results that have pushed Google stock lower. However, it would be a mistake to count Alphabet out for good. Despite the slump in online advertisements, Alphabet still managed to post a 6% year-over-year increase in its Q3 revenue. That gain was driven largely by the 38% annualized growth of its Google Cloud division, which is red hot right now. Additionally, Alphabet maintains a stellar balance sheet. The company reported free cash flow of $16.1 billion in the third quarter, and it has $358.3 billion of total assets versus $104.6 billion in total liabilities. That's pretty impressive. Number 13. Netflix, ticker, NFLX. Reports of Netflix's demise appear to have been greatly exaggerated. Investors who left NFLX stock for dead in the first half of the year must be kicking themselves now as the share price has rallied 55% in the past 6 months, rising from the ashes of a $162.71 52-week low to its current level of $303. The rebound came after the company reported third-quarter earnings that showed it added a better-than-expected 2.41 million net new subscribers in the July through September period. The Silicon Valley-based streaming juggernaut also reported $3.10 in earnings per share, far exceeding the $2.13 average estimate from Wall Street analysts. Heading into 2023, analysts are bullish on Netflix's upcoming slate of programming that includes new seasons of popular shows such as The Crown, Bridgerton, and Squid Game. Analysts are also optimistic about Netflix's new advertising-supported streaming tier that will provide viewers who choose it with an average of 4 to 5 minutes of advertisements per hour when streaming movies and TV programs on the platform. Analysts expect advertisement revenue to bolster Netflix's bottom line in 2023 and beyond. Number 12. Sofi Technologies, ticker, SOFI. Sofi Technologies is a leading fintech business that operates a one-stop-shop banking platform for its users. It operates under 3 main segments, all of which have performed extraordinarily in recent quarters. During the third quarter, Sofi added an impressive 635,000 new products, a 69% increase from the previous year. Moreover, its revenues shot up by a tremendous 56% from the prior year period, with 61% growth in membership numbers. This aggressive approach shows that Sofi is fully committed to comprehensively meeting its customers' needs, making the platform a valuable asset for its customers and investors. Also, with the firm winning a bank charter recently, it's expected to gain immensely in terms of operating margin growth down the road. Number 11. Eli Lilly and Company, ticker LLY. Eli Lilly and Company is a pharmaceutical company that produces innovative drugs and therapies for various health conditions. Its product line includes treatments for oncology, diabetes, cardiovascular disease, and neuroscience, among others. In December 2022, Eli Lilly announced its financial projections for 2023 and plans to launch up to 4 new medicines. In detail, the company is projecting strong financial and operational performance in 2023, with anticipated volume-driven revenue growth and potential launches for several new drugs. Eli Lilly forecasts revenue of between $30.3 billion and $30.8 billion in 2023, driven by key growth products. On a reported basis, the company anticipates 2023 EPS to be in the range of $7.65 to $7.85, and $8.10 to $8.30 on a non-GAAP basis. Number 10. Taiwan Semiconductor Manufacturing Company, ticker TSM. Taiwan Semiconductor Manufacturing, a $400 billion business and the dominant high-level foundry with more than 90% of the market share for advanced chips. In the semiconductor industry, foundries are companies that manufacture chips for other companies, and TSM enjoys dominant market share for chips 7 nanometers and under. Apple, which has started to shift its supply chain away from China, is one of TSM's biggest customers. In response to federal incentives for domestic chip manufacturing, TSM recently committed to building a second plant in Arizona, bringing its committed investments in U.S. manufacturing to $40 billion. TSM is a stock that Warren Buffett owns. It trades at just 13 times its projected earnings for the next year and pays a 2.2% dividend. As of the company's third quarter 2022 disclosure, Berkshire owned a $4.1 billion stake in the company. Number 9. AOG Resources Incorporated, ticker EOG. AOG Resources is a U.S. oil and gas producer coming off a successful 2022 in which shares posted a total return, which includes dividends, of 53.4% through December 15, 2022. Shares nonetheless are still priced like a value stock, trading for less than 10 times earnings and about 8 times forward earnings. Growth will undoubtedly slow down in 2023 as the hot energy market is unlikely to soar as it did in the year 2022, which was plagued by war and inflation. However, investors shouldn't discount the importance of having an inflation hedge in their portfolios. A 2.6% dividend yield and impressively low payout ratio of less than 24% give AOG some credibility with income investors as well. Number 8. Johnson & Johnson, ticker J&J. Johnson & Johnson is a company we all know well. The pharmaceutical giant sells brands we use it such as Band-Aid bandages and Aveeno bath products. They are part of the consumer health business. But J&J makes most of its revenue through its 2 other businesses, pharmaceuticals and medtech. That's where J&J plans on putting the focus as of next year. In 2023, J&J will spin off consumer health into a separate company called Kenvue. This means J&J can move forward and grow its most successful businesses. In the third quarter, pharmaceutical sales rose 9.2% in the third quarter and medtech climbed by 8%. That is, consumer health sales rose less than 5%. The big pharma player also is making moves to reinforce its strengths. It recently announced the acquisition of Abiomed. The medical device company makes pumps that help a failing heart recover. Abiomed has grown sales over about 18 years. J&J expects the deal to add to its adjusted earnings as of 2024. Therefore, 2023 may be a great year to invest in the J&J story. Finally, you'll also want to buy J&J for its dividend. The company is part of a group called Dividend Kings. They've raised their dividends for at least the past 50 years. This means J&J can bring you share performance and growth in passive income. Number 7. Intuitive Surgical, ticker ISRG. The world's foremost expert in robotic surgery is Intuitive Surgical. Due to hospitals delaying surgeries at certain times of the pandemic, revenue was still negatively impacted despite this leadership. The fact that hospitals must purchase equipment and supplies from Intuitive in order to use their robots during surgeries means that the company makes money off of each procedure. Surgery cancellation because of coronavirus hospitalizations is still a possibility. However, it appears to be less of one now than it was a year ago. And with this risk decreasing, Intuitive's future appears promising. Gains have already begun to show. Worldwide procedures increased by 20% in the third quarter. And sales increased by 11%. By repurchasing $1 billion worth of its common stock in the quarter, Intuitive also staked its future on it. Intuitive now has more than 7,300 Da Vinci surgical systems placed in hospitals worldwide. That's a 13% increase over the third quarter of last year. It's also important to note that robotic surgical systems cost about $1 million. So hospitals will likely use the system as long as possible, which should help Intuitive hold onto its leadership. Shares of Intuitive are currently trading at 55 times the estimated forward earnings. And earnings are increasing. 2023 seems like a great time to buy this healthcare stock, given Intuitive's position in the market and recent growth. Number 6. Nvidia, ticker, NVDA. Nvidia is an American multinational technology company based in Santa Clara, California. It is a software and fabless company that creates graphics processing units, GPUs, an API for high-performance computing and data science, and system-on-chip components for the mobile and automotive markets. In workstations for applications in media and entertainment, automotive, scientific research, and manufacturing design, its professional line of GPUs are employed. In addition, Nvidia is a global leader in artificial intelligence hardware and software. Nvidia's most recent results weren't all bad, as the company's data center division generated $3.81 billion, up 61% year over year, and notched a new quarterly record. The segment, which provides processors used in data centers, cloud computing, and artificial intelligence, remained remarkably resilient, even as businesses battened down the hatches for the continuing economic storm. The company continues to be the go-to provider for semiconductors that facilitate the movement of information around data centers and enable each primary cloud provider's vast cloud computing operations. Alphabet's Google Cloud, Amazon Web Services and Microsoft Azure rely on Nvidia's processors. Others include Baidu Cloud, Alibaba Cloud, and Tencent Cloud. When the US government recently banned sending high-end AI and data center chips to China, Nvidia quickly developed a semiconductor to meet its customers' needs while still complying with the newly issued government mandate. This was a critical step in protecting its cloud and data center business, representing the company's most significant growth area. While estimates vary, the cloud computing market is expected to surpass $480 billion in 2022. Achieving a compound annual growth rate of 19.9% over the next 7 years and growing to $1.7 trillion by 2029. The strength of this secular trend and its industry-leading position will continue to drive Nvidia's growth for years to come. There's little doubt that gaming and cloud computing are the company's most significant opportunities, but they're not the only ones. For example, Nvidia continues to be an essential player in the developing area of self-driving cars and trucks. We know developing fully autonomous vehicles will likely take longer than initially anticipated. Still, Nvidia is a crucial provider of the hardware and software necessary to enable this breakthrough technology. Nvidia is partnered with more than 120 movers and shakers in the industry, including car and truck makers, Tier 1 automotive suppliers, robotaxi services, simulation, mapping, sensor, and software companies. While the technology may not be ready for prime time, Nvidia is well positioned to benefit when it eventually makes the grade. This shows that while the current economy is weighing on Nvidia's results, the company is in good shape for a severe rebound once things improve. Nvidia had record-setting sales last year of $26.9 billion, which shows it's the current environment weighing on sales. However, that's a drop in the ocean compared to its total addressable market, which management estimates at more than $1 trillion. According to conventional valuation metrics, the stock of Nvidia is neither cheap now nor has it ever been. However, prices are lower than they have been in a while. Currently, it is trading for about 9 times what it will make in the following year. While most investors consider a reasonable price-to-sales ratio between 1 and 2, high-growth stocks typically deserve a higher premium, and Nvidia certainly falls into that category. The fact that Nvidia is the leader in not just one but 2 industries, has a large market it can sell to and has strong secular tailwinds gives it everything it needs to do well for years to come. That's why Nvidia is one of our top stocks for 2023 and beyond. Number 5. Amazon, ticker, AMZN. Amazon is a leader in two markets set to grow in the double digits this decade: e-commerce and cloud computing. These businesses have helped Amazon grow earnings into billions of dollars over time. But today's higher inflation and other troubles like supply chain issues have been weighing on Amazon. As a result, Amazon's reported declines in operating income and free cash flow has turned into an outflow. This is painful in the short term. The stock has slipped nearly 40% so far this year. The good news is the long-term picture remains bright. Amazon has the market position and financial resources to weather these times. The company's revenue still is growing, and members of its Prime membership program are spending more and more on Amazon. Amazon also is strengthening its cost structure. This will be a plus down the road. Today, Amazon shares are trading for around their cheapest in relation to sales in the past 6 years. So, the best deal this holiday season may be on Amazon shares. Number 4. Teladoc Health, ticker, TDOC. Teladoc Health sank 63% this year. The telemedicine leader disappointed investors with $2 billion non-cash goodwill impairment charges. This deepened investors' worries about the company's lack of profitability. But the most challenging times may be behind Teladoc. In the third quarter, Teladoc narrowed its net loss. In addition, the company's revenue and visits continued to climb in the double digits. And Teladoc said the deal size today was about 50% bigger than the average deal a year ago. Companies hurt by today's economic environment and coronavirus disruptions have taken longer than expected to finalize their Teladoc plans. These are temporary issues. And when the situation improves, Teladoc could see a clear rebound. The company has increased US member numbers and revenue per member from quarter to quarter. Right now, Teladoc shares are trading at 2.3 times sales. This is nearly their lowest ever by this measure. Considering growth prospects, now is an excellent time to get in on this recovery story. Number 3. Vertex Pharmaceuticals, ticker, VRTX. Vertex Pharmaceuticals is one of this year's stock market winners. The shares have advanced 38%. But Vertex may just be getting started. That's because the company is at a critical transition point. The biotech company is already a solid leader in the cystic fibrosis, CF, treatment market. The CF portfolio brings in billions of dollars in revenue and profit annually. But Vertex is about to expand into another significant treatment area. Vertex and partner CRISPR Therapeutics are submitting their candidate for blood disorders beta thalassemia and sickle cell disease to regulators in the US, Europe, and the UK. If all goes smoothly, the product could launch shortly. So Vertex has a clear catalyst ahead. Vertex's pipeline also includes other potentially significant products, such as candidates for pain management and type 1 diabetes. So a few years later, Vertex will still be a CF leader, but it may still carve out significant revenue opportunities in other markets. That's why it's a good idea to get in early on this innovative biotech player. Number 2. Costco, ticker, COST. Costco shares have outperformed the market this year. But they've still lost about 9%. This means they're less expensive in relation to forward earnings estimates than they were earlier in the year. What's another reason to buy Costco now? Today's economic woes work in Costco's favor. That's because the company sells items in bulk and at dirt cheap prices. So as shoppers watch their budgets this holiday season, they may favor buying at a place like Costco and taking advantage of their membership. You pay an annual fee to shop at Costco. So it's to your advantage to do as much of your shopping there as possible. Beyond troubled economic times, this annual fee plays a crucial role in Costco's success. Number 1. Apple Incorporated, ticker, AAPL. Apple is the largest publicly traded company in the world, if you exclude government-backed behemoths such as oil giant Saudi Aramco. Like other tech stocks, Apple shares had a rough go of it in 2022, as recession fears and soaring interest rates spooked investors in the sector. Following a rare 23% pullback, Apple now trades at 22 times earnings, offering investors a sound entry point into the $2.2 trillion iPhone maker. Apple's incredibly sticky ecosystem, customers tend to stay with Apple products, which integrate seamlessly with one another, and ability to upsell more advanced smartphones year after year, lends its revenue a degree of predictability and its stock a measure of safety. While its 0.7% dividend is nothing to write home about, the company is committed to returning its massive cash flows to shareholders in the form of its steadily rising dividend and share buybacks. Apple spent about $90 billion on stock buybacks last fiscal year alone. This concludes our list of 15 of the best stocks to own in 2023. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies. Thank you for watching, and best of luck with your investments.